So how do financial statements factor into the investment process? And how can investors use them to make informed choices?
So just going back to the three key financial statements that every company will need to report with regards to the numbers, which is the balance sheet, the income statement, and the cash flow. So let's go through each one at a time. The balance sheet story revolves around three characters: the assets, the liabilities, and the equity of the company. Now, when you put it together, it tells you something very, very important, because if the company has lots of liabilities, and you know liabilities means you have to pay back your loans, for example, and that from a risk. So the more liabilities you have, the greater risk that you are taking with your business. So in other words, when we look at the balance sheet, we're going to use it to tell us how risky this company is from a balance sheet perspective. If it has low liabilities, which means low risk, then we say this company has got a strong balance sheet. So it's something that you could sleep better at night because the risk of it going bankrupt is quite low. So in other words, to summarize, what the balance sheet does is that it tells you the story of strength, the financial strength of the company. So very, very important. So you want to be investing in strong companies, not financially weak company that may go bankrupt. So the second statement, and that is we call the income statement. So the income statement tells you about the profit story, which is, are you having more sales and revenue compared to your expenses and your cost? So if you are earning more than you're spending, then the result is what we call a profit. And a profit tells you the story of performance. Because if you're profitable, consistently profitable, growing in terms of profitability, then we say this is a good performing company. And that's what everyone wants to be investing in companies like this. Or the opposite could be true. You could be spending more money than you are earning. So the result will then be that you make a loss. And we say this company is not performing, it's a poor performing company, and you want to be avoiding companies that are like this. And the third statement, that's called the cash flow statement. So the cash flow statement tells you about the health of the company cash flow and its bank account. So if you have more money coming into a bank account than money flowing out, and if the money coming in is from a source that is what's called recurring, that means to say every day people are paying you money to buy your products, like Starbucks, for example, McDonald's, for example, then you know that your bank account is going to be very healthy. And again, these are good businesses to be investing in. So three things: you look at the balance sheet story, the income statement, which is the profit story, and the cash flow story.